You ever wonder if that thing you're passionate about, that hobby you know inside and out, could actually give you a real edge in the stock market? Well, today we're cracking open the playbook of the legendary value investor Joel Greenblatt. We're going to see how he and his partner Linda took the chaotic world of retail stocks and turned it into an absolute goldmine.
And it all starts with this quote from Linda Greenblatt. It's so simple, but it's so powerful. She put this philosophy to work and, get this, averaged over 20% annual returns for a decade. How? By focusing on what she knew best, shopping. The lesson here is huge. Your expertise, even in something you think is common, can be your secret weapon. So here's the bottom line. Wall Street analysts, they're mostly generalists. They have to jump from industry to industry trying to get up to speed in a week. But if you followed a sector for years, you just get it. You see the patterns, you understand the customers, you know the competitive landscape in a way that no spreadsheet could ever capture. That deep personal knowledge, that's a massive advantage. And retail is the perfect place to use that advantage, because this is where chaos creates opportunity. See, most people run screaming from retail stocks because they're so volatile. But for a patience investor, that volatility is a gift. It's driven by Wall Street's obsession with the next 3 months, and it's fueled by emotion. People overreacting to one bad month of sales, or everyone panicking and selling at the same time. This creates these huge price swings that have nothing to do with the long-term health of the business. And that gets us right to the heart of the Greenblatt philosophy. This is not about trying to predict the next big fashion trend. No way. The mission is much simpler. Find a good, solid business that's just going through a temporary rough patch. The whole game is to buy when everyone else is selling, when the company is out of favor and the stock is basically on sale.
And just look at this chart of American Eagle. It shows you exactly what's possible. The company was considered off-trend. Their stuff wasn't selling, sales were down, and boy, did the analysts hate it. But the business itself was still solid. It had a strong balance sheet, high returns on capital. So for the investors who bought during that period of doom and gloom, well, the stock tripled as the company got its act together and the market finally woke up to its real value.
So how do you actually do it? Well, the playbook is simple in theory, but it is tough in practice. First, you start by digging through the bargain bin. You're looking for companies whose stocks have just been hammered. Then comes the really hard part. You have to tune out all the noise. Just ignore the panicked headlines, ignore the negative analyst reports. Instead, you focus all your energy on one question. Is this still a good business that can make it through the storm? And finally, you have to have the guts to buy when it feels the most uncomfortable. Okay, enough theory. Let's get our hands dirty. We're going to walk through a real-life case study of the teen retailer Aeropostale, stock ticker ARO, to see exactly how these principles work in the wild. So here's the setup. Aeropostale's stock had been literally cut in half. It plunged from over $32 a share all the way down to around 15. Why? Well, they had some inventory problems, they missed a few sales targets, and Wall Street freaked out, assuming the absolute worst. Now, for most people, a chart like this is terrifying. But for a value investor, this is the signal to start doing your homework. And this slide just lays out the two totally different ways of looking at the situation. On one hand, you have the street, obsessed with the next quarter. They saw rising inventory and just hit the panic button, assuming the company's problems were permanent. But Greenblatt's view? Completely different. He was asking himself, okay, forget next quarter. What could this company earn in 3 to 5 years if things just get back to normal? He saw the inventory issue not as a death sentence, but as a temporary, totally solvable problem. Now, the first step wasn't firing up a complex spreadsheet. Nope, it was time for some old-fashioned detective work, the on-the-ground qualitative research. Go to the malls. Are the stores busy? Talk to the employees and managers. Who is actually shopping there and what are they buying? For Aeropostale, the key insight was that they weren't trying to be a high fashion leader. They were a discounter. Their whole game was competing on price. And that's a really durable advantage, especially in the teen retail space. So once your detective work confirms that the business is still solid, then you pull out the toolkit to see if the price actually makes sense. So let's look at the key numbers Greenblatt used to seal the deal. The first tool is a ratio called enterprise value to EBIT. Now, don't let the name scare you. Just think of it like this. A PE ratio is like looking at a car's sticker price, but EV to EBIT is like looking at the total cost, the sticker price plus any car loans you'd have to take on. It includes the company's debt, which gives you a much cleaner, more honest picture of what you're really paying for its core earning power. And for Aeropostale, the numbers were just screaming cheap. Even on that bad year's depressed earnings, the stock was trading at about 8 times EBIT. But if you just looked forward 1 year, assuming even a small recovery, that multiple dropped to just 6 times. For a healthy business, that is an incredibly low price. It was a massive signal that the stock price was totally disconnected from the company's real long-term earning power.
Okay, the second critical number is return on invested capital, or RIOC. And honestly, this might be the most important number for finding a truly great business. It's basically the company's batting average. For every single dollar it invests in things like new stores or more inventory, how many dollars of profit does it generate? A consistently high ROC, that's the sign of a truly exceptional company. And this was the kicker for Aeropostale. The return on capital for opening a new store was a fantastic 20% after taxes. That told Greenblatt that despite the current problems, the underlying business model wasn't just healthy, it was exceptional. This company had a proven, super profitable formula for growth, and the market was completely, totally ignoring it. So when you put it all together, the strategy becomes crystal clear. It's this powerful 1-2 punch. You start with your own niche expertise, knowing an industry better than anyone. Then, you layer on a disciplined valuation framework, making sure you only buy these great businesses when they are statistically, provably cheap.
Let's just quickly recap the whole journey. It starts with a good company hitting a temporary rough patch. Then you do the work, combining that real-world research with some hard-nosed financial analysis. But the most important step is patience. You have to be willing to hold for 2 to 3 years, just ignoring the market's daily mood swings. And eventually, if your analysis was right, the market wakes up and the price catches up to the company's true value.
So we end right where we started. Look, this isn't just about retail stocks. It's about finding your circle of competence. Maybe for you, it's software or banking or healthcare. The principles are exactly the same. So the real question to ask yourself is, what's the one area where your passion and your knowledge give you an unfair advantage? Find that and you've found your edge.